Are your REIT dividends safe in this high-interest rate world? One of Singapore's most popular industrial REITs, Mapletree Industrial Trust, just released its first quarter FY 25-26 results on 28 July 2025, and the DPU is falling. Is this a red flag or a buying opportunity? If you're a Singapore income investor or looking for reliable dividend streams, this video is a must-watch. I'll break down the key numbers, reveal whether MIT is over or undervalued, and share my independent fact-based verdict. Buy or hold. Stay till the end. You'll walk away with a clear, no-fluff understanding of MIT's financial health and future potential. Like this video so more Singaporeans can learn about income investing, and subscribe to Wealth for You for weekly breakdowns on REITs, dividends, and financial freedom. Disclaimer: this video is for educational purposes only and not financial advice. Always do your own research before making investment decisions. Chapter 1. What are REITs? The basics, minus the headache. Before we get into numbers, let's quickly recap. A REIT, or Real Estate Investment Trust, is like a property-owning machine that collects rent from tenants and passes most of the income back to you, the unit holder, as dividends. It's one of the easiest ways to invest in property without becoming a landlord yourself. No leaking pipes, I promise. Chapter 2. What is Mapletree Industrial Trust, MIT? MIT is a well-known SGX-listed REIT that focuses on industrial real estate. Think data centers, high-tech buildings, business parks, and light industrial spaces. As of June 2025, they own 140 properties across Singapore with 83 properties, North America with 55 properties, and Japan with 2 data centers, fully leased. Their overall occupancy rate? 91.4%. Pretty solid, although it dips slightly from last quarter. The big bright spot is Japan, 100% leased. Chapter 3. MIT's first quarter, FY 25-26. Financial results. The numbers that matter. All right, folks, it's time to talk numbers, the kind that make your portfolio grow, or grown. Here's what came out of Mapletree Industrial Trust's latest earnings report for the quarter ended 30th of June 2025. Gross revenue, 175.9 million Singapore dollars, up a tiny 0.3% year-on-year. Now, this isn't anything to get too excited about. That's basically flat. It shows MIT is holding ground, but it's not exactly firing on all cylinders. Think of it like jogging in place. You're moving, but you're not getting very far. Net property income, or NPI, $133.6 million, up 0.8% year-on-year. A slight improvement, yes, and that's good. But here's the kicker. Inflation is higher than 0.8%, which means in real terms, this income actually shrank a bit. Rising utility costs, maintenance, and insurance can quietly eat away at that gain. DPU, or dividend per unit, 3.27 cents this quarter, down 4.7% compared to last year, and 2.7% lower than last quarter. Oof! That's a meaningful cut for income investors. So, what's going on? So, why did the dividend shrink? It's not because properties are underperforming, occupancy is decent, and rent is coming in. The issue is below the surface. Higher borrowing costs, as MIT is refinancing debt in a higher interest rate environment. That eats into distributable income. There are also weaker contributions from joint ventures, especially in North America, where interest expenses from repricing interest rate swaps are rising. And while the revenue is steady, costs like foreign exchange losses and higher tax expenses are chipping away at the bottom line. So you've got a situation where revenue is stable, but dividends are declining, and that's a signal we can't ignore. Chapter 4. Is MIT overvalued or underpriced? Valuation deep dive. All right, Time to put on our valuation goggles and see whether MIT is a bargain or bloated. Let's break it down with a quick stock health check. Kinda like taking MIT's blood pressure, but financially, right? First up, market capitalization. MIT is currently valued at around 5.8 billion Singapore dollars. This puts it comfortably in the mid-cap REIT space, big enough to be stable, but not so large that it can't grow meaningfully. Next, price-to-earnings ratio, 17.2 times. Now, this is moderate for a REIT. It's not ultra-cheap, but also not in bubble territory. For context, below 15 times might signal undervaluation, while above 20 times could be considered expensive unless growth is strong. At 17.2 times, MIT is sitting in the fairly valued zone, especially for a REIT with global diversification and defensive cash flows. Moving on, price-to-book ratio, 1.15 times. This means investors are paying about 15% more than MIT's net asset value. But wait, that's not necessarily bad. For high-quality, well-managed REITs, this is actually normal. Investors often pay a slight premium for strong management, prime locations, and reliable dividends. So, 1.15 times is not a red flag. It shows the market has reasonable confidence in MIT's asset base and growth plans. Now, return on equity, 6.7%. This isn't sky high, but for a REIT, it's solid. REITs typically aim for mid-single-digit ROEs due to their capital-intensive nature and payout obligations. A 6.7% ROE suggests MIT is using unit holders' capital efficiently, a positive sign for long-term investors. So, is MIT overvalued? Short answer, no. MIT appears to be fairly valued, not a screaming bargain, but definitely not overpriced either. When you factor in stable revenue from long leases, a strategic focus on data centers and high-tech assets, a diversified global portfolio, and disciplined capital recycling, it's easy to see why the market gives it a slight premium. If you're a long-term income investor, paying 1.15 times book for a well-run REIT like MIT with a 6.35% dividend yield and good future prospects, that's not a bad deal at all. Chapter 5. Dividend Yield and History. Is it sustainable? Okay, dividend hunters, let's talk about the real reason many of us love REITs. That sweet, sweet passive income. MIT's current dividend yield stands at a solid 6.35%. Now that's well above what most fixed deposits or CPFOA give you, and still higher than the average SGX REIT. So it definitely ticks the box for income investors. But here's the important part. Is it sustainable? Let's take a closer look. This quarter's DPU is 3.27 cents. This dividend was funded mainly from MIT's operating income, not from one-off property sales. That's important because it tells us the payout is supported by actual rental earnings, not financial engineering or temporary gains. Last year, MIT did boost distributions slightly using divestment profits, like from the Tanglin Halt cluster. But that bonus support is now gone, meaning what you see in this DPU is closer to the real earning power of MIT's portfolio. Now, DPU trend. There's been a slight decline. Yes, the DPU is down 4.7% year-on-year, which may raise some eyebrows. But remember, interest costs have gone up. USD contributions from joint ventures have weakened due to FX, and the REIT is also retaining flexibility to reinvest and manage debt. So while the dividend dropped slightly, it's still fully covered by earnings, and that's a strong sign of sustainability. Dividend dates to note. Ex-dividend date is 4th August 2025. Hold your units by then to be entitled to this payout. Dividend payment date is 8th of September 2025. That's when the cash lands in your account, so don't miss it. So in short, Yes, the dividend may have dipped a little, but it's coming from a solid base of recurring income. As long as occupancy stays strong and interest rates don't spike further, MIT should continue to deliver stable, predictable distributions. And in this uncertain market, that's exactly what many Singapore investors are looking for: income they can count on. Chapter 6. Future Prospects of MIT. All eyes on the Fed. So, what lies ahead for Mapletree Industrial Trust? To answer that, we need to zoom out beyond just Singapore, because what happens in the U.S. economy and at the Federal Reserve can ripple right into MIT's distribution and valuation. Let's break this down. Big picture. It's a mixed outlook for growth. MIT is well positioned with its strong base in Singapore, a fully leased Japan portfolio, and a long-term strategy to focus on data centers and high-tech buildings. The REIT is actively recycling capital, unlocking value through smart divestments, and keeping its gearing manageable. But it's not all sunshine and dividends. The challenge? North America. Occupancy is still soft, and a big chunk of MIT's income is tied to joint ventures in the U.S. So, we need to talk about what's happening with interest rates and currency risk. U.S. interest rates. The elephant in the room. Right now, the U.S. Federal Reserve is playing it cautious. After aggressive rate hikes to tackle inflation, they're widely expected to hold rates steady in the short term. Jerome Powell, the Fed chair, isn't giving strong signals about a cut just yet. But here's the interesting bit. Markets are pricing in up to 2 rate cuts before the end of 2025, with September being the earliest likely window. So what does this mean for MIT? If those rate cuts do happen, especially in the fourth quarter, MIT's borrowing costs on its U.S. debt could decline, and the USD might stabilize, both of which would boost joint venture distributions, support DPU recovery, and potentially lift investor sentiment toward the REIT. But it's not guaranteed. The Fed is currently caught in a tug-of-war between slowing job growth and weaker GDP on one side, and tariff-fueled inflation on the other. With Trump's tariffs driving up prices, like toys up 1.8%, furniture up 1%, inflation could hit 3% by year-end, well above the Fed's 2% target. That may delay or reduce the scope of cuts. On top of that, there's political pressure mounting on the Fed, which could influence internal dynamics and market uncertainty, not exactly the stable environment REITs thrive in. FX impact: the USD is still a drag. Even though MIT has hedged 89.3% of its distributable income into SGD, a prolonged USD decline will still erode income from U.S. assets over time. The hedging helps in the short term, but long-term fundamentals still matter. If the Fed eventually cuts rates and the USD finds a floor, that could ease the FX drag on MIT's distributions in financial year 2026 and beyond. Now, MIT's strengths going forward. Singapore anchors the portfolio with strong occupancy and positive rent reversions. Japan provides stability with fully leased data centers and long WALEs. Capital recycling shows they're not sitting still. They're actively improving the portfolio. Debt is mostly fixed or hedged, and leverage is expected to drop to 37% post-divestments. So the key takeaway? MIT isn't broken. Far from it. But it is navigating headwinds. The next 6 to 9 months will hinge heavily on 2 macro levers: whether the Fed starts cutting rates, and how fast, and whether North American leasing improves and starts contributing meaningfully again. Until then, investors may have to temper expectations for dividend growth, but not stability. If you're investing for steady, long-term passive income, MIT still deserves a place on your radar. Just be ready to ride out the macro waves while collecting a respectable 6% plus yield. Final thoughts: buy or hold? All right, it's decision time. So, is Mapletree Industrial Trust, or MIT, a buy or a hold? My view? It's a hold with an accumulating mindset. In other words, if you already own it, you're fine. Sleep easy. And if you're looking to enter, this might just be a good time to start building a position slowly, especially if you're in it for the long term. Here's why. MIT isn't in distress. It's just sailing through a slightly choppy market, one that's testing almost every REIT out there. But the core fundamentals are solid. The Singapore portfolio is strong and growing rents. The Japan properties are fully leased and stable. The REIT is making smart moves to recycle capital, and it's backed by a resilient 6.35% yield. Now, will dividends bounce back quickly? Probably not. But with the Fed likely to cut rates later this year, we could see borrowing costs ease, FX stabilize, and distributions slowly recover, especially from their North American joint ventures. So if you're a long-term income investor looking for passive cash flow, MIT remains one of the more resilient and well-managed choices on the SGX. Key things to watch in the next quarter: occupancy trends in North America, signals on Fed rate cuts, the USD-SGD exchange rate, and stabilization or rebound in DPU. If these trends move in the right direction, MIT could offer both capital upside and income stability, a win-win for patient investors. If you found today's deep dive helpful, give this video a thumbs up so more Singaporeans can discover it. Subscribe to Wealth for You for more REIT reviews, dividend insights, and passive income strategies, all explained in plain English. And don't forget to tap that notification bell so you never miss a new upload. Until next time, invest smart, stay steady, and may your dividends grow like your Kopi stash. Ding! See you in the next one.